What's up, everyone? Marcus Warren here with Warren Wealth Management. So, whenever you listen to financial experts, there's one topic that will almost always come up, and that's interest rates. But what do interest rates have to do with your portfolio and wealth? Well, it turns out a whole lot. Let's discuss. So, when you hear the term interest rates on the news, it's usually referring to what's called the federal funds rate, which is the rate that banks use when borrowing from one another. This interest rate is the benchmark set by the Federal Open Market Committee, or the FOMC, and it factors in current economic conditions like inflation, employment, and GDP growth. But why should you care about this federal funds rate? Well, because when the country's benchmark interest rate changes, it has a downstream effect on everything from your mortgage to your investment portfolio. In fact, just a 1 percentage point decline in interest rates can increase your disposable income across the earning spectrum. So, take for instance, I'll give you an example, a home mortgage. So, you're looking to purchase a home that, say, it's $346,900. With a 7% mortgage rate and a 20% down payment, your monthly payment would be about $1,846. But if your rate decreases by just 1%, you pay $1,664, which is a savings of $182 per month. And if you factor that in for 30-year mortgage, that's a savings of $65,691. So mortgage rates, that's just one example of how that can directly affect your wealth. So while economic growth is good, too much of it can lead to an overheated economy where prices are rising and inflation is a concern. In these scenarios, the FOMC is likely to increase interest rates to help maintain economic stability. However, an increase in the Fed's funds rate is usually not good for stock prices since corporations have a harder time borrowing money and expanding during high interest rates periods. So hopefully, the correlation between interest rates, stocks, debt, and the economy is starting to click. We hope. But you should keep in mind that when interest rates change, there is usually a lag time between the policy change and its effect on the economy. Now, according to research from the Federal Reserve Bank out in St. Louis, it can take anywhere between 18 months and 2 years for interest rate changes to have an impact on the economy. So, the next time you hear about potential interest rate changes, remember that it will take some time before its effects are felt in the economy and your portfolio. And as always, if you have any questions or would like to talk, just let me know. Until next time.